Welcome back. The other big story which impacted the banking names is the RBI proposal of a 5% increase in the liquidity coverage ratio for banks to meet the cash needs of the digitally enabled retail customer. Also, it's eyeing higher liquidity for certain unsecured credit. This could hurt the profitability of banks. Krishnan Sitaraman, the Senior Director and Chief Ratings Officer at CRISIL Ratings, is joining us on the show now. Thank you for joining in. Your initial estimates, and have you done some analysis of which might be the banks most impacted?
Yeah, thank you so much for having me on the show. Good morning, everyone. See, the recent guidelines by RBI, or should I say the proposed guidelines, the objective essentially here is to enhance the resilience of the banking system to any form of short-term liquidity crunches or run-on deposits and so on. So our assessment is, if these guidelines were to be implemented as is, there would be an impact of around 10 to 30 percentage points in terms of the liquidity coverage ratios, or LCR, of the banking system from bank to bank. At a median level, currently we have assessed around 31 banks constituting more than 90% of the assets of the banking system. The median LCR comes down from around 136% to 117%. So that's the kind of delta. But the delta may vary from bank to bank, depending on the extent of retail depositors so that they may have, the extent of granularity of their deposits, and so on and so forth. So essentially, that is the kind of delta, around 19 odd basis points on a median level, but overall around 10 to 30 basis points. Around 26 of our 31 banks which we have looked at do fall in that window of 10 to 30 bips. There are a few banks where the impact on the LCR is higher, but in those banks, even after taking the shave off, the revised LCR is still above 160%. So in that way, that does not have too much of an impact on their standalone liquidity profile.
Okay. Krishnan, just to take that point forward, is there a clear divide, PSU versus private kind of a divide as to where the impact shows up more, or is it more granular bank to bank? And then which are the banks where you think they'll really have to quickly pull up their socks and build this LCR buffer?
Yes, I think that's a good question. That said, there is no major, I would say, difference on a category level. So as to this is the trend in public sector banks, or this is the trend in private sector banks, it is essentially varying from a bank to bank. It is also, as I said, depending on factors like extent of retail depositors, extent of granularity, and so on and so forth. The other angle here is the call that individual banks take as to what level do they want to bring back their LCR covers after the implementation of these guidelines. As I said, the numbers may come down, but it is still at a median level of 117%. It is still above the regulatory requirement of 100%. So it is possible that some of the banks whose liquidity coverage ratios have maybe come down, but still are at maybe 140, 150%, they may not want to take it back all the way to the previous levels. So that is a call that individual banks will take. But coming back specifically to your question, on an average level, we see the private banks LCR coming down by around 22% points, and public sector banks around 20 percentage points. So on an average basis, there is not much of a difference.
Got it. So now, given what you just said, that most banks in any case are well above the regulatory threshold, so they may not rush to quickly shore up the LCR again, then why are you concerned about a potential impact on credit offtake and a further maybe impact on NIMs? These are banks anyway struggling to move on deposits, and now if they start running to build up LCR, then maybe there's a business hit. But why are you worried if they're anyway above the regulatory threshold?
No, I would just like to rephrase. It's not a significant worry as such, but it is a trend. So when we look at the individual bank-to-bank variation, we see 17 of the 31 banks that we have looked at, after the implementation of the norms as is, would have an LCR of less than 120%, as against only 3 banks in the universe which have such a ratio. And around 9 of these banks would have an LCR of less than 110%, as against none in the current dispensation. So some of these banks will need to kind of have a reasonable level of cushion above the regulatory minimum. They may not take the number all the way up to the existing level. That's the discretion that they have. But they typically, the banks tend to operate.
Oops.
When that happens, there are 2 things which will actually play out. So if you have to build up your high quality liquid assets to shore up the LCR, what that would mean is that the resources that will go towards that will not be available for credit dispersal, which means that the credit growth may be somewhat tempered from our existing projections of around 14%, which is again lower than the 16% which we saw last fiscal. And also, because of this additional amount being deployed in potentially low yielding investments, that can have an impact on the NIMs. We have already projected that the NIMs of the banking system will come down by 10 to 20 bips as compared to what we saw last fiscal. That could be somewhat more elevated this fiscal, depending on how actually these norms and the execution of those play out.
Okay, but this is going to be effective only next year, right? 1st of April,
That's right.
2025.
April 1, 25. That's right.
How much might the credit growth get impacted and NIMs? You've analyzed 31 banks. What would be the average?
So as I said, it is very premature to actually come out with some numbers, because the extent of impact will depend on the strategic decisions each banks will take. So now if the banks decide that they want to take the LCR all the way up to the current levels, then the impact can be higher. But as I said earlier, some of these banks may take the call that, okay, I will just take it up by somewhat a margin, but not all the way up to the earlier levels. So as I said, some of the banks who have had who will face a higher hit on the LCR are actually, even after the hit, having an LCR of 160%. So they may not want to take it up too much higher. So we'll need to watch out for. And also the other dimension variable here is what are the final kind of contours of the guidelines which come out. Today, currently, it is a draft guidelines. RBI has sought comments on that. So once the final guidelines come out and we have some bit of visibility on the strategies that the banks will adopt, we can have a better handle on projecting the exact impact in terms of numbers.
Okay, we'll leave the conversation here for now. Thank you very much for joining in. Get into a break. We'll come back with more on the market. Stay tuned. Thank you for watching CNBC TV 18. For all our top stories and news updates, follow us on our social media platforms.